Hi, let's go over some of the questions you've been solving this week. This week you went through IAS 28 and IFRS 11. So this video, in fact, I'm going to do a series of videos that will help you to go over what you have already done. Please, we are going over to reinforce what you have learned, because I want to encourage you that you don't solve a question once and then get it. So you must do it again and again. So everything you've done this week, I'm trying to go over some of the questions, not necessarily all, some of the questions. In IFRS 11, I'll do the video in two parts. I'll do the essay part and then I'll do the computation part so that I can keep it short for you. So in question one, for example, you have been given three scenarios and the requirement is for each scenario, analyze whether a joint arrangement exists and which parties have joint control. Now, joint, with IFRS 11, joint arrangement is where two or more parties jointly control another entity. And so you are just trying to establish that the control is in the hands of two or more. Okay. And then the other aspect is to also figure out which of the parties of the arrangement have joint control. So it tells you that you can have A, B, C, D having a joint arrangement, which means they jointly are in control of another entity. However, only two have the actual control because they must take decisions. Okay, so take note of that. In scenario one, the decisions about the relevant activities require unanimous consent of A, B, and C. And so this is what actually shows who has joint control. First of all, A, B, and C are in a joint arrangement. A, B, and C are in a joint arrangement. So it means they collectively are in charge of another entity. But the control is in the hands of all three of them because they unanimously must agree, all three. And therefore, you can see that it has nothing to do with the percentage in this scenario. It has nothing to do with the percentage. They are together, three. So they are parties to a joint arrangement. A is a party to a joint arrangement. B is a party. C is a party. But the control is in the hands of all three because they all need to unanimously agree. So the joint control is about who takes decision about the relevant activities. All right. Then in scenario two, decision about the relevant activity requires 75% voting right. 75% voting right. And now that has defined the decision about percentages. And so you now come and see the percentage holding of each of the party to the arrangement. So A is a party, B is a party, C is a party to the arrangement. But who has the right to decide the relevant activities? And it must be 75%. And therefore, you are looking at A and B collectively having that 75% because A alone cannot, B alone cannot, B and C cannot. And so it has to be A and B. And so A and B jointly control the arrangement. In scenario C, again, it is 75%. But look at the percentage sharing. It can be A and B, or it can be A and C, because A has 50. It can get 75 if it joins with B. It can get 75 if it joins with C. The standard said 75. Now, what the no, the question, the scenario says 75. What the standard says is, if you have a situation like this, then there is no clarity who have joint control. So you need more information. So in scenario 3, it is inconclusive. We cannot conclude on the parties with joint control, because it can be A and B or A and C. So the question is who? And because we can't answer that question clearly, scenario C, the party, we don't know, or we cannot conclude on the parties that have joint control. So that's how you answer a question such as this. In question 2, Abui entered into an agreement with Badu and entered into an agreement with Kokui. And so the requirement is appropriate standard. Discuss how the transaction should be accounted for. So there are 3 issues to look at. You refer to the appropriate standard, and when you read the question, contractual agreement to produce a product, undertaking one manufacturing process, you know it is IFRS 11, joint arrangement. Then you must go on and classify. And then the classification is whether you have a joint control, whether you have a joint venture or a joint operation. Now, when you indicate that the arrangement is a joint arrangement per IFRS 11, you might want to just explain what a joint arrangement is about. An arrangement that in which 2 or more parties a contractual arrangement in which they control another entity, and a joint control is where the decision about the entity must be unanimously agreed among the parties. So it's something like that. Then you continue to classify. Now in the classification, you are trying to classify as to whether it is a joint venture or a joint operation. Now with the first scenario, for example, Badu, it is Abui and Badu. Now Abui takes a manufacturing process and Badu takes another. So they are each responsible for a particular part of the business. Both parties have agreed that decision must be made unanimously. So the 2 of them have joint control that is established, and that will bear their own expenses and take an agreed share of sales revenue from the product. This immediately tells you this is a joint operation. Each party is doing a bit of the business. So it is a joint operation. And therefore, to account for a joint operation, the parties must apply the provisions of IFRS 11 and take their share of assets and liabilities and recognize them in both their individual and consolidated financial statements. So if the joint operators are also parents on their own, then they will have a consolidated financial statement, and then they will take their share of the joint operation assets and liabilities, incomes and expenses, and add it to their assets and liabilities in their own separate financial statements. That's what it means. So that's the accounting part. So don't just classify and go. Tell us what the accounting will be. In a separate agreement, Abui and Kokui decide to form an entity. Now, the presence of an entity does not mean anything as far as the issue is concerned here. Now, since this point, there is no separate entity sometimes they call it separate vehicle. There is no separate entity. It is surely a joint operation. Because for a joint operation, if there is no separate entity, it is a joint operation. But with a separate entity, it may be a joint operation or a joint venture. So the fact that the question says they decide to form a separate entity, you do not conclude. You have to still continue, because this information can be a joint operation or a joint venture. So Abui will own 55 equity and Kokui will own 45 equity. Again, it's not conclusive, because whether joint operation or joint venture, there will be percentages to deal with. Then they agree that decision making regarding the entity will be unanimous. So again, we have a joint control between Abui and Kokui, and that they will have interest in the net asset. And this is where you pause and you conclude. You will now conclude that this arrangement is a joint venture because the parties to the arrangement have interest in the net asset and are not interested in the assets and liabilities, rather the net. Now, guys, there is a difference between having interest in assets, having interest in liability, and having interest in net asset. In a net asset, you don't know how the asset was acquired. You don't know, you are not even interested in how they acquire it. What means they use? It means somebody else is thinking about that. But when the person acquires the asset and the obligation and net off, then you come. I want my share of the net. But in an operation, it means as a joint operator, you must know the asset and your portion of it. So even if somebody else buys it, you must go and take your portion of that asset. If somebody else goes for the loan, the liability, you as a joint operator must go for your portion of that liability. Your interest is in the asset and the liability. So you must note those differences, and that's how you decide whether there is a joint operation or a joint venture. And once you decide that Abui and Kokui have a joint venture, then it also means you must account for the transaction by applying the provisions of IAS 28, accounting for associates and joint venture. And it means equity accounting. You have to look at the marks that may be allocated to know how much essay to write, because you have to be simple, straight to the information. But if you are allotted a lot of mark, it means a lot more is expected of you. If you are allotted small, small is expected of you. Okay. In question 3, again, it's about classification. So we have two entities, Dromo and Shida. And then there is a separate entity, Eastmore. So at this point, we don't know if it is a joint operation or a joint venture, because there is a separate entity. Now, Dromo is a party, Shida is a party, and they have formed a separate entity. They have set up a separate entity. And now, the contractual arrangement between the entities establish joint control. So they have joint control of the activities that are conducted. The main features of Eastmore's legal form. So when there is a vehicle, then you have to find out the structure, the legal structure and form of the entity, and that is what will help you decide whether the separate entity gives rise to a joint operation or a joint venture. Now, the main feature is that entity entity and not the parties. If you take your eyes off this, you will conclude wrongly. It is the entities and not the parties has rights. So Eastmore, the separate entity, has rights to the asset and has obligation to the liabilities. That's what this is about. It is not Dromo, it is not Shida. Dromo and Shida do not have rights to the assets and obligations, the liabilities. It is ISMO, the separate entity. ISMO as a legal person, an entity, and the only um liability that Dromo and Shida will have in case ISMO has an issue with a third party is whatever they contributed to ISMO, whatever they contributed and nothing more. So it's a limited liability. It is a limited liability. If it is not a limited liability, it means when ISMO is in trouble, Dromo and Shida must be arrested and charged. But here they have relinquished the right to the assets and the obligation to the liability to the separate entity. So they, as parties, are not interested in the assets and liabilities of the separate entity. And then again, we are told that the parties have the right to sell or pledge because their interest is only in the net asset. It means they can offload it to another person or use it for something because it means you only have shares in the separate entity. All right. Each party receives a share. So they do everything and you only take part of the profit according to your shareholdings. And so you can conclude at this point that this is a JV, a joint venture, because Dromo and Shida are only interested in the net assets. Now, once you conclude like this, you then have to add that since it is a joint venture, Dromo and Shida must each account for their business by applying the provisions of IAS 28 and equity account for the transactions that are equity account for the investment in Eastmore. Okay, so that's about this, and I think that's about the essay type question. So I'll come back on the computation ones. Read, justify your discussion, refer to the standard,